Welcome to the Deep Dive, brought to you by Talk Tickers. We pull out the key insights from the earnings calls moving the markets.
Hey there.
Today, we're diving into Paychex's first quarter results for their fiscal year 2026. It's quite the interesting setup.
It really is. You've got this situation where the company posts really solid, 17% revenue growth. They even raised their full-year earnings forecast.
Sounds great, right?
Yeah, but then the stock immediately hit some friction. Dipped pretty noticeably, actually, and on heavy volume, too.
Right, that's the core tension, isn't it? You have this operational success story, but then this, market disappointment.
Exactly.
So that's our mission today. Let's unpack what's going on with the Paycor integration, figure out these GAAP headwinds everyone's talking about, and really understand what management thinks is driving this double-digit growth momentum.
Okay, let's start with a quick take, the headline numbers.
Lay it on us.
All right. Adjusted EPS, so earnings per share, came in at $1.22. That actually beat the consensus by a cent or two, represents about 5% growth year over year.
Okay, a beat on adjusted EPS. What about revenue?
Revenue was $1.54 billion, right in line with what the street expected. And that's where you see that strong 17% year-over-year growth. That's the big number.
So operationally, check, they delivered. But you mentioned the stock dip. That caution must have come from somewhere else. What spooked investors if the adjusted numbers looked okay?
Well, you got to look under the adjusted figures. The GAAP EPS, the generally accepted accounting principles number, tells a starkly different story.
How different?
It actually decreased 10% year over year, dropped to $1.06.
Wow, a 10% drop on GAAP versus 5% growth adjusted? That's a big gap.
It is. And that compression, that's basically the sound of the financing for the Paycor deal hitting the books. The single biggest factor here was interest expense.
Ah, the debt.
Exactly. Interest expense jumped by, get this, $58.6 million compared to last year. It hit $68.2 million just for the quarter.
$60 million more in interest. That's substantial. So when we talk about financial friction, we're talking real cash costs here, servicing that Paycor acquisition debt. Is it all the interest, or are there other non-cash things hitting GAAP too?
It's overwhelmingly the debt service. Sure, there's always some amortization with acquisitions, but the sheer cost of carrying that debt, especially now with higher rates, that's driving the wedge between adjusted and GAAP earnings.
So it's cost of capital for the deal really showing up.
Precisely. You often see two kinds of friction in integrations, right? Operational people, systems, and financial the debt. Paychex seems to be handling the operational part well, but that financial friction is loud right now.
And that debt burden flows right down to margins, I assume.
Yep. Adjusted operating margin dipped a bit. It was 40.7%, down from 41.5% last year. Investors see that margin pressure and, they start asking questions about the long-term profitability of this whole combination.
Makes sense. So the heavy trading volume, the stock drop, that was investors zeroing in on this near-term P&L pain, the GAAP hit, the interest expense.
That's the picture. It forces the market to ask, is this just temporary noise, or is this higher interest cost a permanent feature that changes how we value Paychex? Management's job on the call was really to argue for the former.
Okay, let's shift to that argument then, the operational side. Management solutions, that's the core business, right? How did that do?
Did great. Revenue surged 21% to $1.2 billion. And they were pretty clear, about 17 percentage points of that 21% growth came directly from Paycor.
So Paycor is definitely contributing to the top line.
Oh, absolutely.
Yeah.
Management sounded quite confident. They called the start to fiscal 26 strong, said the Paycor integration is on track. And let's talk synergies, because that's the payoff for the deal.
Right, cost synergies first.
They're sticking to their target of around $90 million for the fiscal year. But importantly, they also slipped in that they're actually on track to exceed those initial expectations.
Exceeding cost targets, that's a good sign. Shows are executing.
It really does. They said most of the actions needed to get those savings are already done. That gives some real confidence in where the expense line is headed.
Okay, hitting cost targets is good discipline. But the real long-term value, the reason you take on all that debt, is revenue synergies. Cross-selling, right? How's that going?
Yeah, that was a focus. They're pushing hard to sell Paychex's own services, things like retirement plans, ASO, PEO, into Paycor's client base, which is around 50,000 businesses.
Any specific example?
They gave a pretty compelling one. They closed an ASO deal with a former Paycor client that has several thousand employees. They flagged it as one of the largest ASO deals in Paychex history.
Okay, quick reminder for listeners, ASO is Administrative Services Organization. It's like PEO, but Paychex manages HR and benefits without being the employer of record. That sounds like a solid proof point for the cross-sell strategy.
Definitely reinforces the strategic rationale. Getting those Paycor clients onto more comprehensive, higher margin paycheck services, that's the whole game.
Makes sense.
They also tackle the complexity of tracking growth now. Said they're not really focused on reporting Paycor's old standalone growth rate anymore.
Why not?
Because they've intentionally mixed things up.
Yeah.
They moved Paychex clients, the ones over 100 employees, onto the Paycor platform. So it's all blended now.
So they're basically saying, look at the segment's performance now, not the historical pieces. They accepted some disruption to integrate faster.
That's exactly it. They stressed that the sales performance in the new combined structure is actually beating expectations. They pushed through the pain of realigning sales territories and strategies quickly, hoping it smooths out later this year.
Beyond just integration, what about product innovation? I saw something about AI tools.
Yeah, they're leaning heavily into AI and digital. They expanded their generative AI assist, they call it AI Insights, to their PEO clients now too.
What does it do?
Imagine being an HR manager and just asking in plain English about pay equity or turnover trends or labor costs across your workforce and getting an instant answer. That's the idea. Pretty powerful for mid-market companies.
And they're using AI internally too, right, for efficiency.
Correct. They launched an internal Gen AI tool for their own HR specialists. And here's the kicker. They trained it on data from almost 40 million client interactions they handle each year.
40 million? That's a massive data set.
Huge proprietary advantage. It helps their own people answer complex questions faster and more consistently, which should help with costs and service quality. Ties back into hitting those synergy numbers.
That scale really does make the synergy confidence more believable.
Aye.
What about partnerships? There was a Bill Pay launch?
Yes, the Bill.com partnership. They launched Bill Pay powered by Bill. It integrates accounts payable right alongside payroll and HR for small businesses.
How does that fit strategically?
It's less about making tons of money directly from Bill Pay itself and more about making their platform stickier, especially for accountants. Enhances their CPA portal offering, makes the whole Paychex bundle more indispensable.
Okay, so despite all this integration work, innovation spending, and crucially, that massive debt service cost, management still felt confident enough to raise their full-year outlook for adjusted EPS. That's pretty bold.
It really is. They bumped the forecast up to 9-11% growth for adjusted diluted EPS. That's up from 10.5% previously, and they held firm on the total revenue growth target of 18.5%.
Where does that confidence come from?
Directly from hitting and exceeding those synergy targets and see the revenue synergies start to come through earlier than perhaps planned. It suggests the core underlying business, if you strip out the financing noise, is actually performing better than they initially thought.
Let's pivot slightly to the PEO and insurance solutions segment. That was the slower spot, right? Only 3% revenue growth. Why the lag there when management solutions is flying?
Yeah, it looks slow on the surface, but the underlying story is different. Operationally, it was actually pretty strong. Management talked about mid-single-digit growth in worksite employees and the actual number of employees they manage, plus double-digit bookings and record client retention.
So if they're adding employees and booking new business, why only 3% revenue growth? Where's the disconnect?
It's being dragged down by a couple of specific temporary things. First, there's a known headwind from the Florida Multiple Employer Plan, the MPP.
Okay, what's that?
It's a way for small employers to pool together for insurance. Changes in regulations and rates there created a tough comparison for Paychex this quarter versus last year. It's an external factor impacting the revenue calculation.
Got it. So not a sign of weakness in attracting clients necessarily. What was the second headwind?
The other piece is rate pressure on the workers' compensation side of their insurance agency business. Last year, the rate environment was unusually favorable, making this year's comparison difficult. It's more of a cyclical thing in that industry.
Okay, so both are temporary comparison issues.
Exactly. And management expects to anniversaries, both of them basically, cycle past the tough comps in the second half of this fiscal year, fiscal 26.
That clarifies things a lot. So we should actually expect PEO revenue growth to accelerate later in the year as those headwinds fade. The underlying business sounds healthy.
That was the message. PEO is operationally sound. The reporting growth is just messy right now because of these temporary factors.
And zooming out, what do they say about the broader economy? Small business health.
Cautiously optimistic, which definitely supports raising guidance. They see small businesses holding up well. Employment is stable. Wage inflation is moderating. It's been below 3% for 18 straight quarters now, which is pretty remarkable.
No signs of recession in their data.
They explicitly said they see no signs of recession among their clients. And interestingly, they pointed to recent policy clarity, like the tax bill getting finalized, the Fed rate cut as boosting business confidence a bit, encouraging some investment and hiring.
Okay, so let's put it all together. We have really strong operational momentum, synergies ahead of schedule, AI innovation, a raised outlook, and a stable macro view. It brings us right back to the start. Why the sell-off? Why the market hesitation?
It just circles back to that GAAP versus adjusted story. The market is definitely watching execution, but it got hung up on the cost of that execution, specifically the cost of the Paycor deal. Investors laser focused on the GAAP earnings dilution and that huge step up in interest expense. It overshadowed the underlying strength.
The market basically said, nice revenue growth, but that debt looks expensive.
You got it. And the key thing for the stock going forward, the catalyst for it to potentially re-rate higher, is seeing proof that those margins will recover.
When the GAAP and adjusted numbers start coming back together.
Exactly. When that convergence happens, likely in the second half of FY26, as integration costs fade and synergies fully kick in, that's when management believes the market will recognize the true earnings power. Until then, you have this financial indigestion overhang.
Which makes the whole narrative. Strong company, temporary financial awkwardness, creating maybe an opportunity for investors with a longer view.
That's the potential setup.
All right, this brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based entirely on the tensions we've just discussed. Remember, this is purely hypothetical, designed to make you think.
Okay, the core thesis here is simple. We think the market is getting Paychex wrong right now. It's fixated on temporary pain, the acquisition costs, the high interest rates, and it's missing the bigger picture.
Which is?
The structurally higher revenue growth, the fact they raised EPS guidance despite the costs, and the strong integration execution. We're betting the market's overly focused on the temporary drag.
So the idea is to bet on that changing.
Precisely. We're targeting the inflection point where the margins start to visibly recover.
Okay, lay out the trade.
We'd structure a leveraged long position on Paychex, ticker PHCX. Give it a 12-month horizon. The specific target is that moment, likely in the second half of fiscal 26, when the synergy benefits fully flow through, costs normalize, and you see clear GAAP margin repair.
So this is a conviction bet that the negative 10% GAAP EPS drop and the big interest bill are just noise the market will eventually look past.
Exactly. It's a bet that the fundamental story, 16.5% to 18.5% revenue growth, raised EPS, ultimately wins out over the current financing headaches.
Betting on operational execution and that P&L normalization to drive the stock higher.
That's the play. Targeting the multiple re-rating when investors shift focus back from the balance sheet debt to the income statement growth.
A very clear catalyst-driven idea. Interesting.
We think so.
Okay, so let's recap our deep dive. Paychex put up strong Q1 revenue, 17% growth, and raised its full-year adjusted EPS forecast to 9-11% growth. That's underpinned by the Paycor integration, running ahead of plan on cost savings, and starting to show real revenue synergy momentum.
Right, positioned for sustained double-digit growth. But the market initially blinked, focusing instead on the near-term hit to GAAP earnings and margins from acquisition costs and that much higher interest expense.
Which leaves us and you with the final question to mull over. Is that negative stock reaction just temporary acquisition indigestion that will pass as the numbers normalize? Or is that sharp rise in interest expense a more permanent structural drag that the market is right to be worried about for Paychex's valuation?
Something to think about. Thanks for joining us for this deep dive.
We'll catch you on the next call.